the OBR's press briefing for our 2025 Fiscal Risks and Sustainability Report, both to those of you here in person and the many people joining us online. I'm Laura Gardner, Chief of Staff at the OBR, and I'll be chairing today's event. We're extremely pleased to be launching this report in Liverpool, and so I'd like to start by thanking Liverpool City Council for hosting us and making us feel so welcome. I'm joined by the three members of the OBR's Budget Responsibility Committee, the Chair Richard Hughes, Professor David Miles and Tom Josephs. In a moment, Richard is going to run us through a summary of the report that we've just published, after which the committee will take your questions. You could submit these at any time via Slido, which you can access via the link on our website. Before Richard does that, I'd like to start by thanking, on behalf of the committee, staff from the OBR for all their hard work in putting this latest report together, and officials across government for their input too. Of course, all the analysis and conclusions continue to represent the BRC's own independent judgments. With that, let's hear from Richard.
Thanks, Laura, and good morning, everyone. It's a pleasure to be here in Liverpool for the launch of our 2025 Fiscal Risks and Sustainability Report. And for those of you who are less familiar with these reports and perhaps more familiar with our economic and fiscal outlooks, the purpose of our FRS is to draw people's attention to the near-term risks and longer-term pressures, which are not in our medium-term forecasts for the economy and public finances, but are still important for policymakers to understand and manage if they want to meet their fiscal targets with confidence in the medium term and ensure the public finances are on a sustainable path in the long term. Let me start by putting the contents of this year's FRS in the context of the current state of the UK's public finances. As you can see from the chart on the left, the UK's public finances have emerged from a series of global economic shocks in a relatively vulnerable position. At the end of 2024, the UK government's deficit stood at 5.7% of GDP, which is around 4 percentage points higher than the advanced economy average, and the third highest amongst 28 advanced European economies. Efforts to put the UK's public finances on a more sustainable footing have met with only limited and temporary success over the past 15 years. As you can see from the chart on the right, while getting some measure of public debt falling as a share of GDP has featured in 8 out of 9 UK fiscal frameworks since 2010, underlying debt has risen by 24% of GDP over the past 15 years, and by 60% of GDP over the past 20. The rise in debt since 2010 is partly due to the pandemic and the energy crisis, which hit the UK economy particularly hard. But borrowing remained elevated, and debt has continued to rise in their aftermath because successive governments have reversed plans to consolidate their public finances and loosened the fiscal rules, which are now amongst the loosest we've ever had. At 95% of GDP, public debt is now at its highest level since the early 1960s, and is projected to rise further over the medium term. And there are signs that the scale of public borrowing in the UK and other large advanced economies is putting global sovereign debt markets under pressure. Government borrowing costs have risen across the world and are now higher in the UK than in any other major advanced economy. Volatility in the cost of the UK's growing stock of debt is just one of many potential claims on the narrow margin the government's left itself against its fiscal targets of eliminating the current budget deficit and getting net financial liabilities falling by the end of the decade. Against this more challenging backdrop, the scale and array of risks to the UK's fiscal outlook remains daunting. In this year's report, we focus on 3 sources of fiscal risk in greater depth. Chapter 2 looks at the UK system of public and private pensions. Chapter 3 explores the composition of the public sector balance sheet. Chapter 4 updates our estimates of the fiscal risks from climate change. And Chapter 5 provides an update on the other risks in our fiscal risk register. Starting with pensions, one notable feature of the UK system is that it's a mixed economy of public and private provision. Total income from pensions in the UK is around 10% of GDP, split roughly evenly between public and private schemes. As you can see from this chart, most other European countries tend to have both a more expensive and more state-dominated pension system. The UK's mixed system of pension provision means that the associated fiscal risks can come from several sources. The most direct is the state pension, whose costs are projected to rise due to population ageing and the triple lock. Risks can also come from gaps in private pension saving, which could give rise to both direct and indirect pressures on the public finances in future. Finally, private pension schemes have historically been important buyers of government debt, also known as gilts, and structural shifts in the pension sector are likely to have an effect on the demand for and cost of that debt. Starting with the first of these, the state pension is the second largest item on the government's budget, and annual spending on it has risen steadily from around 2% of GDP in the mid-20th century to around 5% of GDP or £140 billion today. Part of this rise in the cost of the state pension has been due to the steady rise in life expectancy over this period. As you can see from the chart on the left, in the FRS we explore the spending implications of alternative scenarios for life expectancy going forward. Our central projection assumes that life expectancy at 65 rises from 21 to 26 years by the early 2070s. These demographic changes explain just under 60% of the projected 2.7% of GDP increase in the cost of the state pension over the next 50 years. In a high life expectancy scenario, where life expectancy at 65 instead reaches 29 years, state pension spending is 0.7% of GDP higher than in our central projection. While in a low life expectancy scenario, where life expectancy at 65 instead falls slightly to 20 years, spending is 0.8% of GDP lower at the projection horizon. But as you can see from the chart on the right, uncertainty about the operation of the triple lock is an equally, if not more important source of fiscal risk. Higher than expected volatility in inflation and earnings has meant that the triple lock has already cost around 3 times more than we expected since its introduction in 2012, at around £15 billion by the end of this decade. So in our report, we also explored the implications of different assumptions about the future behavior in inflation and earnings for the cost of the triple lock. Our central projection for state pension spending is based on the pattern of inflation and earnings outturns between 1992 and the present, and sees state pension spending rise from around 5 to 7.7% of GDP over the next 50 years. Were the future behavior of inflation and earnings to look more like the volatile period from 2010 onwards, state pension spending would be 1.5% of GDP higher by the early 2070s, or over £43 billion in today's money. By contrast, were inflation and earnings to look more like the less volatile 2 decades prior to the triple lock's introduction, spending would be 1.3% of GDP lower by the early 2070s. Let me turn now to the potential fiscal risks coming from the private pension sector. One positive development in recent years has been the success of auto-enrollment in increasing pension participation. As you can see from this chart, the proportion of employees saving in a pension has risen from under 50 to almost 80% over the past decade. You can also see that all of that increase has come from a more than doubling in the number of employees enrolled in defined contribution schemes, which has more than offset the steady decline in those enrolled in defined benefit schemes. However, as we highlight in the chapter, some groups, including low earners, renters, and the self-employed, are still at risk of undersaving for retirement, despite the auto-enrollment revolution. This brings me to the final important source of fiscal risk coming from the pension sector, which relates to the changing structure of pension schemes and its implications for overall demand for UK government debt. As I mentioned earlier, the last 30 years have witnessed a shift in the weight of pension savings from DB to DC pension schemes. As you can see from this chart, this shift from DB to DC is likely to have a significant impact on overall demand for government debt, as DB schemes tend to hold much of their assets in gilts, especially long-term index-linked gilts, while DC schemes tend to hold far fewer gilts and are more heavily invested in riskier assets, such as equities, in both the UK and around the world. The implications of this DB to DC shift for overall pension demand for gilts can be seen from this chart. Pension scheme holdings of gilts are projected to more than halve as a share of GDP, from just under 30% today to just over 10% by the middle of the century, with slowly rising DC demand being nowhere near sufficient to make up for the steep fall in demand from DB schemes. This poses a fiscal challenge for governments, who, as you can see from the chart on the left, have historically relied upon pension schemes to purchase between 1/3 and 2/3 of their total debt issuance. And while the Bank of England has taken up a significant share of net issuance since the financial crisis, it's now also in the process of winding down its holdings of gilts. The need to entice more price-sensitive buyers into the market, such as overseas investors, could, we estimate, push up gilt yields by around 0.8 percentage points, some of which may already be reflected in market prices. And these overseas investors are, by their nature, as comparison shoppers in the global debt market, likely to be more fickle and flighty than their domestic counterparts. Let me now expand our horizons beyond just looking at the government's principal liability in the form of gilts, to take a broader view of the public balance sheet, which is the focus of the second chapter of our report. In October of 2024, the government adopted a new fiscal rule targeting public sector net financial liabilities, known as PSNUFL. This represented a break from past fiscal frameworks, which have traditionally focused on the narrower concept of public sector net debt, or PSND. As you can see from the second column of this chart, while PSND captures all debt liabilities of the public sector, it only nets off its holdings of liquid financial assets, principally foreign exchange reserves and cash deposits. Relative to PSND, PSNUFL captures, as you can see from the third column, a wider range of financial liabilities, notably those of funded pension schemes, and a wider range of financial assets, notably illiquid assets such as loans and equity investments. But as you can see from the right-hand column, PSNUFL is still narrow in coverage than the most comprehensive measure, public sector net worth, which captures all liabilities, including those of unfunded pension schemes, and all assets, including physical assets such as land, buildings, military equipment, infrastructure, and intangible assets. Over the past 2 decades, the size and complexity of the government's financial balance sheets expanded considerably. Since 2004, net financial liabilities have more than doubled, from 33% to 83% of GDP. Within this, financial liabilities have more than doubled, from 57% to 132% of GDP, due to an increase in gilt issuance and to finance quantitative easing and other Bank of England activities since 2008. And financial assets have also nearly doubled, from 26% to 50% of GDP, reflecting growth in funded pension schemes, student loans, and loans to businesses. The wider balance sheet coverage of PSNUFL means that it's exposed to a wider array of risks than the narrower debt measure. And in the chapter, we explore 3 potential sources of risk to the outlook for PSNUFL. There are risks that arise from new financial transactions, which involve a subsidy element, such as concessional loans, which would increase net financial liabilities. In addition, the value of PSNUFL is exposed to changes in the valuation of assets and liabilities that are already on the public sector balance sheet. And finally, PSNUFL is exposed to changes in the classification of institutions into and out of the public sector. To illustrate the second of these risks, we explore 3 kinds of valuation shocks: a 1 percentage point reduction in the discount rate used to value public pension liabilities, a 10% fall in the market value of equity assets on the balance sheet, and a 30% decrease in the value of the government's loan book. As you can see from this chart, these shocks would raise the level of PSNUFL by between 1% and 2.5% of GDP in the year of the shock. But because the government's fiscal target is to have PSNUFL falling as a share of GDP in the later years of the forecast, the rule is still met in all cases. A final set of risks to the outlook for PSNUFL comes from the potential reclassification by the ONS of near public sector bodies, which are currently classified to the private sector, but provide essential services or serve an important policy purpose. To illustrate the potential scale of these risks, this chart looks at the impact of a potential reclassification of private water companies into the public sector. Moving from left to right, water companies only have around £12 billion in financial assets, shown in the first 2 purple bars, which will be recognized in PSNUFL. But they have £91 billion in debt and other financial liabilities, shown in the second 2 bars in green, which would also be recognized in PSNUFL. This means that the net impact of their reclassification into the public sector would be an increase in PSNUFL of around £78 billion, or just under 3% of GDP, shown in the large black bar. And while water companies also have £94 billion in non-financial assets, mainly the water network shown in purple, these physical assets would not count toward PSNUFL, which only counts financial assets. Let me now turn to the last of the main chapters in our report, which looks at the fiscal risks from climate change. As you can see from the chart on the left, the world is on course to exceed, by the end of the decade, the Paris Agreement goal of limiting the rise in global temperatures to 1.5 degrees centigrade above pre-industrial levels. And as you can see from the chart on the right, the costs of a hotter and more volatile climate are also rising, with economic and insured losses from extreme weather up 29% and 38% respectively on the previous decade. Climate change creates risks for the public finances through 3 main channels. First, there are the costs to government of climate change mitigation, that is, the actions necessary to reduce our carbon emissions and limit our contributions to the rise in global temperatures. And these were the focus of our 2021 Fiscal Risks Report. Second, there are the economic and fiscal consequences of the physical damage caused by climate changes that still occur despite those mitigation efforts, and these were the focus of last year's FRS. Third, there are the economic and fiscal implications of adapting to a hotter and more volatile climate, and we'll be looking at these in a future FRS. Chapter 4 of this report focuses on updating and integrating our previous estimates of climate-related damage and mitigation to get a more comprehensive estimate of the fiscal implications of climate change. Starting with climate-related damage, our latest estimates of the economic and fiscal costs of a 3-degree rise in global temperatures is significantly higher, with real GDP being 8% lower by the early 2070s, which is 3 percentage points more than in our previous estimate, and the primary fiscal deficit projected to be 2% of GDP higher by the early 2070s, which is around 0.7 percentage points higher than our 2024 estimate. These increases in the estimated costs of climate damage are largely due to a more comprehensive and up-to-date analysis of climate-related damage to the UK economy, which takes account of not just higher temperatures, but also higher precipitation and more extreme weather events. Turning to the fiscal costs of mitigating climate change, our latest central estimate of the cost to government of reducing the UK's carbon emissions to net zero by 2050 is around £30 billion per year. As you can see from the chart on the left, around two-thirds of this cost comes from lost tax receipts, mostly from fuel duty as petrol-driven cars are replaced by electric vehicles. The remaining third is a central estimate of the state's share of the economy-wide investments needed to transition our energy, transport and heating systems from fossil fuels to renewable sources. The chart on the right shows that our latest central estimate of the cumulative fiscal costs of the net zero transition at 21% of GDP is 9 percentage points lower than our previous estimates. And this falling cost is mainly driven by a reduction in the Climate Change Committee's estimates of the whole economy costs of reaching net zero. For the first time in this report, we can also combine our estimates of the fiscal costs of climate damage and mitigation into an overall estimate of the fiscal risks from climate change. While it's tempting to want to infer some trade-off between investments in climate mitigation and reductions in climate damage, the reality for a relatively small emitter like the UK is that these costs are likely to be additive rather than substitutes. So in our central 3-degree centigrade scenario, the combined fiscal impact of climate damage adds 94% of GDP to government debt by the early 2070s, relative to our latest long-term projection. But as you can see from the other bars on this chart, this is one of an array of possible scenarios for the fiscal cost of climate change, which stretch from, on the far left, a low fiscal cost scenario costing just 34% of GDP, in which the government accepts a much lower share of the economy-wide investment costs of getting to net zero, and finds a replacement for the lost revenue from motoring taxes. And on the far right, a scenario in which the damage from climate change is twice our central estimate, and debt is 137% of GDP higher by the early 2070s. In conclusion, the UK's public finances have exited a series of global shocks in a relatively vulnerable position. At the end of last year, the UK government had the 6th highest debt, the 5th highest deficit, and the 3rd highest borrowing costs among 36 advanced economies. UK government debt is now at its highest level since the 1960s and set to continue rising over the next 5 years. The report we published today explores only 3 of the many sources of risk to the public finances over the coming decades. The final chapter of the report, an associated risk register, considers a larger array of other risks I've not mentioned, including rising global trade tensions, upward pressure on defence spending in Europe, and uncertainty around the medium-term outlook for the UK economy. Given the frequency and severity of shocks that the UK economy and public finances have experienced in recent years, any appreciation of the fiscal outlook cannot be based solely on a central forecast of tax spending, borrowing and debt, but also needs to take account of the inevitability that at least some of these risks will materialise. And with that, I'll hand it back to Laura to chair the Q&A.
Thank you very much, Richard. So now we've got plenty of time for questions. As a reminder, you could submit these via Slido, which is available at the link on our website. I should definitely start by checking if there's any questions in the room. Do stick your hand up if so. I can't see any right at this minute, but I'll wave at me frantically at any point and I will definitely come back to you. So we'll go to some questions online, of which we've got quite a few, so we'll get through as many of them as possible. There's a couple in relation to our work on pensions, which I might come to you on, David. The first one is from Tom Rees at Bloomberg, who asks, given the shift in pension scheme holdings and also the Bank of England's QT programme, will this leave the UK too exposed to foreign investors and swings in sentiment? And another question in the same area, DC schemes tend to want shorter maturities than DB. I think that's the right way around. How much of a fiscal risk is this? So could you take those two?
Good questions. Good exam questions. Right. Well, it's certainly true that the Bank of England looks like it's going to be running down its holdings of UK government bonds, gilts, and that probably happens on a faster trajectory than the more slow-moving sell-off by the pension sector on their gilts. Because if you think about the pension sector, they've built up their gilts over a long period of time. Defined benefit schemes largely closed, not all of them, but in the private sector largely closed. Pensioners will be paid their pensions, and so the liabilities fall off, and they sell the gilts gradually over time. The Bank of England probably is going to sell most of its gilts over a slightly shorter time horizon. So two relatively big changes there. On the Bank of England thing, and without wishing to get too much into the weeds and the plumbing of the UK financial system, and what's happened with the Bank of England is they buy a load of UK government bonds and they're financed by reserves, which are basically deposits held by the commercial banking sector in the UK. The commercial banking sector in the UK before the financial crisis didn't hold many reserves at the Bank of England because they thought there's never going to be a financial crisis. Then they get into a complete mess and the UK banking system is cratered, back in 2008, 2009. And now the commercial banks want to hold more really safe assets at the Bank of England, reserves at the central bank. So if the Bank of England sells a load of gilts, somebody buys them, and that reduces the reserves of the banking system. So the banking system probably wants to actually rebuild its reserves, and they might be buyers of the gilts to some extent. So there may be more of a kind of offsetting demand as the Bank of England runs down its holdings of gilts in the private sector, particularly in the banking sector. The DB pension system is a slightly different story, and there isn't an obvious natural buyer to the gradual selling of gilts by the pension funds. But there's always a price at which you can induce somebody somewhere in the world, maybe in the UK, maybe outside the UK, to buy the gilts. And it may well be that they prefer to have shorter dated bonds, coming back to the second part of the question. Mm-hmm. So it seems likely that two things will happen over the longer run. Firstly, in order to sell all the government bonds that the government needs to keep selling, it may, over time, need to pay a slightly higher interest rate. And we do some calculations in the report which say that could be worth somewhere between 0.5 and 1 percentage point in the very long run on the cost of UK government debt. That is not trivial. It's also probably the case that the people selling the bonds, the pension funds, wanted to hold long-dated gilts, long-dated loans to the UK government, and the people that might replace them might have a preference for shorter-dated bonds. So if that were to happen, and it seems plausible, the UK government would be issuing shorter-dated debt in the future than it has over the last 30, 40 years. That poses some issues because it means they then have to roll over that debt more frequently, and it exposes them to sort of short-term volatility in interest rates because you've got to keep rolling over debt that you issued 1, 2, 3 years ago every couple of years. There's a bit of an offset to that because the yield curve, which is the interest rates on debt of different maturities, tends to slope up a bit. So it may well be that what happens is, on average, the UK government has to pay a bit more for debt in the future than it has in the past. That's in itself not terribly helpful. If it's issuing shorter debt, because normally you get a higher interest rate on long debt than short debt, that offsets to some extent. But there's a bit more volatility and unpredictability in the cost of government debt because you're having to roll it over every few years as opposed to having lots of 20, 30, 40-year debt. There's a lot of moving parts there, but I think on the whole it makes it a somewhat more challenging environment in the future for UK funding its debt.
Thank you, David. That was a very comprehensive answer. We've got a question in relation to some of our work on climate, which I might come to you on, Tom, and then some very big questions, Richard, which we'll come to next. You can prepare yourself for. So we'll go to climate first. Simon at City AM says, you say the government spending review net zero plans are £7 billion lower than your central scenario for the government share of investment costs. Has the government therefore under-budgeted for net zero?
Okay, thank you very much. So we, in the report, look at a set of scenarios for the share of spending to fund the transition to net zero that may fall on the government. That is quite uncertain. The government obviously has a wide range of choice in terms of the policy levers it can use to drive the transition through government spending, through taxation, through regulation, and that is obviously a matter for the government to choose. The estimates for the share of government spending that we use are based on the Climate Change Committee's projections of the whole economy costs, and then we make assumptions on the share of that may fall to the government. At the spending review, the government announced spending on net zero for the next 4 years, That is actually within the range of the scenarios that we set out in the report for the overall cost that might fall to the government, including the cost of Sizewell, which the government announced at the spending review. The costs of the spending allocation to net zero is actually broadly in line with the central scenario that we have published in the report. Excluding Sizewell, it's closer to the low scenario, but it's certainly, I think, within the range of those scenarios that we've set out there. I mean, it is also just worth emphasising the point that Richard made in the presentation on this, which is actually that the biggest cost to the government that we identify from the transition to net zero is not on the spending side, it's the loss of revenue, in particular from fuel duty, which accounts for around 2/3 of those estimated costs to government. And as Richard showed at the end, in a scenario where the government chooses to replace that lost fuel duty with another form of revenue, then the overall cost of the transition to net zero fall quite significantly.
Thank you. I think we've got a question in the room, which we'll go to next. Can we get a microphone over here? Tell us who you are and what your question is. Just there.
Thanks. Sorry, David Robinson, Market News. Just wondered, you've got the different topics you're addressing here. If you look at the one that David Miles just talked about, the shift from defined benefits to defined contribution, unwinding of QE, those are long-running structural factors. You then have a section on triple lock. Now, unlike the others, that is a political issue, and any government at any time could just abolish the triple lock, okay? Or you could set options for replacing it with something. You're in a position where the OBR does not evaluate manifestos. It could be 4 years from election, and you're going to put something out, people say, well, we've already said what we've said on that. Do you worry this just disappears into being another number put out by the OBR that does not end up being incorporated into political debate? Because the triple lock as a vote winner, it's very attractive.
And I'll add to that. Sue Chan has asked online, is the triple lock sustainable? Which is definitely on the same theme. Does anybody want to come in on the triple lock? Richard, can you start?
I mean, so it's one of a series of age-related pressures that pushes upward on public spending steadily over a number of years. And as you saw in our previous report, when you project trends in both pension spending and health and other age-related spending forward, the UK public finances are in an unsustainable position in the long run. The UK cannot afford the array of promises that it has made to the public if you leave those unchanged based on a reasonable assumption about growth rates in the economy and in tax revenues. We produce these reports to draw attention to these issues, and our hope is that there is some attention paid to them. I mean, precisely what government does in response, to these pressures and the choices that ultimately every country is going to have to make about how they afford their welfare states and their wider public services commitments are issues for politicians. I think the issue is that they need to understand the sort of choices and trade-offs they face, because we've currently got debt of 100% of GDP. If you leave the public finances on autopilot with existing policy settings, that goes up to 270% of GDP. The UK has never had debt of that level in its recent past, and so it is a trajectory it can't sustain. Our job, as given to us by Parliament, is to point these issues out and try and feed them into the discussion about policy choices. And I think one thing to point out about sort of the rising cost of pensions is that it's partly due to demographics, but it is partly due to the design of the triple lock itself, which when it was designed, we had one understanding of how volatile the outlook for inflation and earnings was going to be. As we have all experienced in the last few years, inflation and earnings have turned out to be much more volatile. We've seen double-digit inflation in the UK, which was not envisaged when the triple lock was introduced, and that contributes around half of the extra cost of pensions going forward. It's not just demographic changes, not just the aging society. It is also the fact that you have the way the indexation of pensions works. The more volatile inflation and earnings are, the more expensive it turns out to be in the future.
Richard, I'm now going to ask you a few questions, which I think you might tell me that you're not allowed to answer, but I'm going to ask you them anyway, and you can see how you get around that. So I'll ask you a few. They're all kind of on the same theme. Sue Chan from The Telegraph asks, with many risks crystallising in the next decade, does this mean more decisions will have to be made this Parliament on taxes and spending? Chris Smith from The Times asks, does your comment about the inevitability of shocks and not basing the fiscal outlook on the central forecast mean the Chancellor should be leaving more headroom? And someone else who is remaining anonymous asks, how should the government respond? Should there not be an urgent financial statement before recess? Oh, actually, that's from Paul Franks. He doesn't know. There you go. So that's some big questions which you can attempt to answer or not answer.
Yeah, so we do these reports and these updates once a year. Behind them is a much longer fiscal risk register, which looks at around 50 different risks facing the public finances. We just draw out 3 for particular highlight in this report, but you can see the full list on our website, and it's summarised in a final chapter in that report. And the reason we maintain this is to basically try and keep track of how are these risks performing over time? Are they going up? Are they going down? Is the government getting on top of some of them? And what this update revealed, an update in that register since our last big update in 2023, was that there are some risks which the government has mitigated, some risks which have diminished in scale, but they tend to be the smaller to medium-sized risks, whereas some of the bigger risks have gotten bigger and more likely. And that's perhaps best illustrated in the area of defence spending, where the government has more or less fully funded its near-term commitment on defence spending, which was to increase it from 2.3 to 2.5% of GDP over the next 2 years. But it's added on top of that a 1% of GDP commitment to increase defence spending further to 3.5% of GDP going into the next decade. So I think in that sense, some near-term risks have been funded and mitigated. Others have been created, obviously, in the last few weeks. But also, the government has also stacked up some other much more expensive longer-term commitments now on defence, but also, as we discussed, commitments around pensions, commitments on health spending and in other areas, which, as yet, if you just leave unaddressed, continue to add to fiscal pressures on the government. I think in light of how risky the 2020s are turning out to be, the Chancellor has left herself, and actually her predecessors, her recent predecessors, have also left themselves relatively small amounts of headroom against their fiscal targets, given the degree of risk, the fiscal outlook, just over a 5-year horizon. This Chancellor left herself about £10 billion worth of headroom against her fiscal rules in the last 2 fiscal events. Her predecessors have also left themselves relatively small amounts of headroom. That is not very much given the array of risks to any 5-year outlook for the economy and public finances. It's also relatively small compared to the headroom set aside by her predecessors. The average to set aside against a set of fiscal targets is around £30 billion. Some chancellors set aside as much as 80. And it's important to bear in mind that all of those amounts of headroom turned out to be not enough, because many of those fiscal rules ended up being breached. So given the array of risks out there, chancellors do need to aim off for their fiscal targets by considerable amounts. Recent chancellors have not set aside very much, given the risks they face.
Thank you. Excellent. We've got a wide range of questions online, some ranging slightly broader than this report. There's quite a few on the theme of welfare, so I will just take, I'll take those together and probably come to you, Tom. So will the government, Nolzo from The Telegraph asks, will the government's U-turns on welfare reform and winter fuel payments damage the public finances? Mauricio Alensar at City AM asks, what's the costs of the government's welfare spending U-turns? The OBR has given figures for defence spending commitments to 2035. Abandoning welfare reforms has weakened the public finances. What quantum of tax revenue would be needed to get the books back into a good place? So I think those are all on the same theme. Can you give us some insights on that, Tom?
Yeah, thank you. So in terms of the cost of the policy changes that the government has announced, we will essentially incorporate an estimate of that into our next forecast at the budget in the autumn. We do policy costings alongside fiscal events, so we can incorporate them in the forecast, and so we're not able to provide estimates ahead of that point. At that point, we will also look at any other policy announcements that the government makes that have come out of the welfare reform green paper. There were actually a number of proposals in that green paper that we didn't cost for the spring statement, either because the policy detail at that point had not been fully specified, quite often because the government was consulting on further details, and also we were not able to estimate any employment impact of the reforms, again because at the time the policies were quite often not fully specified or the analysis of potential employment effects had not been done. So there will be quite a lot of updates for us to do at the budget to look at the overall costs and any impact on employment. I mean, what we do in this report on welfare in the risk register section is highlight the underlying pressure on the public finances from the very significant increases in incapacity benefit and disability benefit caseloads that we have seen in the country since COVID. Caseloads up by around 1 million people, costs increasing by about 20 billion. In the forecast, even taking account of the savings from the welfare reform package as it was at the time of the spring statement, we still had a forecast which saw spending on those benefits increasing by about 15 billion. So it is a very significant pressure on the public finances. It's also the case that the underlying drivers of that are not fully clear. It's likely to be a combination of pressures from changes in underlying health of the population, also likely to be a result of changes in the labour market, the economy, cost of living pressures, and also related to the structure of the welfare system in terms of generosity, conditionality, and just the operational delivery of benefits. And so because those drivers are relatively uncertain, there is also just quite a lot of risk around the underlying forecast, aside from the sort of additional pressures created by the government's policy changes last week.
Thanks, Tom. Another theme covered in our risk register is productivity, and we have quite a few questions on that topic too. Richard, I might come to you first on process, and then David for anything you want to add. Where have we gone? John Paul Ford Rojas asks, has the underperformance of productivity increased the likelihood that projections for productivity growth will be downgraded, and what would be the implications? And where's my other one gone? Alex Elgin asks, how significant are fiscal risks for the government's finances from UK productivity underperforming your forecast, and what weight should we attach to the current projections? There's a few more on that topic, but largely the same.
We're here today talking about our fiscal risk and sustainability report. We're not providing an update to our medium-term forecast. We're not going to be doing that again until the autumn. In the meantime, over the summer, we do what we call our supply-side stocktake, where we look at the long-term drivers of potential output in the UK, labour supply, investment, and also total factor productivity. That's a process we are in the midst of, and we will conclude that in time for the autumn forecast and inform the Treasury of the results as the basis for the new forecast on which they will be preparing the autumn statement. But it is evidently the case that the assumptions that drive our productivity forecast and indeed the productivity performance of the UK is one of the most important drivers of long-term fiscal sustainability and near-term fiscal prospects. I mean, just a 0.1 percentage point change in productivity growth over the next 5 years would be enough to speak for the headroom that the Charter set aside in the March forecast. So it is a very important assumption that drives our economic and fiscal forecasts. It's not one on which we have much to say today, but we will update first the Treasury and then include the outcome of that supply-side review in our autumn forecast.
Yes. I mean, how significant is it? It is the single most significant thing for the fiscal outlook. If you ask why is the stock of government debt in the UK now 100% of GDP, and before the global financial crisis it was hovering around about the mid-30% of GDP. So it's 70% of GDP increase in the stock of debt in the UK. It's not unique to the UK, but it's absolutely enormous. Probably hasn't happened outside world wars in the history of the country. Why did that happen? Because we used to have productivity in the UK growing at about 2% or so a year. For the last 17 years, it's grown by about 0.5%. So for 17 years, 16, 17 years, we've lost, between 1.5% and 2% of GDP every year. That adds up to, not far off 30% of GDP. There's a 30% cut in the resources the UK has relative to what you might have expected before the financial crisis if we'd just gone on the trajectory we've been on since the Second World War. So how significant is that? It tells you everything you need to know, almost, about why we've got such a large amount of government debt today. The big question is, why did it happen? And what do you learn about what's going to happen over the next 5, 10 years? Is the next 5, 10 years going to be a continuation of, by historical standards, rubbish productivity growth? Or may we get back to something a bit more normal? To answer that, you need to think about, well, why did we have such bad productivity growth? Well, one set of factors is a whole series of bad shocks that hit the UK. Global financial crisis, COVID, UK GDP falls 10% in 2020. Then you have the Ukraine is invaded, huge increase in energy prices. Government steps in to try and buffer the household sector from the big increase in energy costs. And some people would put Brexit in the same category as a shock that's probably not a positive for productivity. So whilst it is true that the OBR's view on productivity has been more optimistic than most people, one reason for that is our interpretation, to some extent, looking back over this terrible period of productivity, is you just had a series of things that hit the UK every 5, 10 years like a great hammer coming down on somebody's head. And hopefully, the next 5 or 10 years doesn't see the UK hit over the head with a big hammer every 5 years like it has over the last 15 years. But having said that, the longer it goes on, about very low productivity, obviously you've got to assess whether your best central forecast of productivity growth is about right or too optimistic or too pessimistic. So we're in the process of doing all that now. In fact, we're more or less continuously in the process at the OBI thinking, is our current estimate of where we're going in the UK still a central forecast? What the forecast has been is productivity growth. As I said, it used to be 2.5% in the good old days before the global financial crisis. Then it falls to 0.5%. Halfway between those numbers is about 1.5%. So we've kind of taken the view that maybe the future is halfway between the dismal past 15 years and the much better 60 or 70 years before that. That's not super scientific, but I'd like to see somebody have a sort of better way of looking into the fog of the future. But we continuously see whether or not our method of looking into the fog in the future is right or not, and we will adjust as appropriate as we assess the evidence.
Thank you, David. Still got quite a few questions. Do remember to wave at me in the room if you want to interject. I'm happy to hear from you. Tom, probably come to you on this one, on the state pension age. The report assumes state pension age rises based on a 2017 policy that was not reaffirmed at the more recent review. Has the government commented on this assumption?
Okay, yeah, thanks. So in the projections of the cost of state pension, we assume 3 increases in the state pension age. There's one actually in our medium-term forecast toward the end of the 2020s. Then we have another in the 2030s and another in the 2060s, I believe. And we base that essentially on the kind of policy commitments that have been set out by previous governments. I mean, these are pretty material, actually, in terms of their impact on the fiscal numbers. It is a route via which some of the pressure from the state pension is alleviated over our projection period. We had some analysis in the last of our medium-term forecasts which showed that the increase in the state pension age later in this decade saves around £10 billion from the cost of pensions. And overall, across our long-term projections, the three state pension age changes together reduce spending by the end by around 1% GDP. So it is pretty substantial. The reason, to go to the question, the reason we use the assumption of the second increase in the 2030s is because that was the recommendation of the pension review in 2017, and the government at that point accepted that recommendation, although it is the case that the sort of underpinning legislation has not yet changed. It's also the case, however, that the fiscal impact is not that sensitive to the precise date at which those changes happen. So the most important thing is that those three changes happen within the projection period, and you get those savings that I mentioned. Those savings are not that sensitive to the exact date at which they happen.
Thank you. Coming back to our work on balance sheets, so I might ask you first, Richard. We've got a couple of questions in this space. Tom Rees at Bloomberg asks, is there a risk of longer-lasting shocks to the value of equity and loan assets which would hit Persnuffle in the fifth year? For example, a major revaluation of asset prices. So I think that's kind of, we presented a scenario where the shock happened in the first year. And there is also a question on a similar theme, which keeps running away from me. Is there a risk that government buys dodgy financial assets that look good for Persnuffles but are bad for fiscal sustainability?
So on the risks, there are certainly risks that could be a shock to the level of Persnuffle. If you face a sudden fall in equity prices, those equities are largely the equity investments of funded pension schemes in the public sector. In both the ONS's data and in our forecasts, those assets are marked to market. So if their market value falls, their value falls on the recorded government balance sheet. And so you could see a level shift in Persnuffle as soon as those market prices change. Similar things could happen in loan assets, particularly if what you see is rising default rates on those loans. That would mean that the book value of those loans as held on the balance sheets of things like the British Business Bank or the National Wealth Fund get written down, and that could again deliver a sort of level shift to Persnuffle. They may also, to some extent, change the trajectory depending on what assumptions you make about the growth in those assets going forward. So I think you can see both level and trajectory shifts in terms of what those mean for public sector net financial liabilities. Although, as we showed in the report, sort of level shifts tend to be more dramatic than trajectory shifts, given where we are. But sort of anything is possible. I think that there is a risk, and one of the reasons why we wrote this whole chapter, and one of the reasons why we are doing further work in this area, is that by opening up the opportunity of borrowing for financial investments, be they equity investments or be they loans, they do create the risks that that kind of flexibility is exploited, and that rather than spending money on things, government starts lending money to people to do things as a way of taking advantage of the flexibilities of this rule, because in principle that would be Persnuffle neutral if the asset is worth as much as the borrowing. I mean, the issue is if the government is providing concessional lending, subsidised lending, loans that it doesn't expect to be repaid. Both we, the organisations doing the lending, and the Office of Financial Statistics need to take a hard look at the valuation of those loans to make sure that, look, if there's a 50% probability of default, we're booking those at 50% of their face value, rather than in the expectation that there will be full repayment. There are some precedents for that in the way in which we have the ONS has treated, and we have scored in our forecast, the student loan system, because the government does not expect full repayment of those loans by the time that they mature, and there may be a case for treating other loans that the government enters into in a similar manner.
Thank you very much, Richard. David, I'll get you to tackle this one. When considering future financing costs, to what extent does the OBR make assumptions around the credit rating downgrades and the consequent rise in spreads? What do you think about that one?
We don't make assumptions, because overwhelmingly what we do is we look at the market prices of government bonds as it is right now. Almost literally minute by minute you could look at this, and those prices, which are in a sense the interest rates that people require to hold government debt, themselves reflect the potential risks of holding UK government debt. And there are risks, of course. There are risks that inflation picks up and you've got a UK government bond that's going to pay you 4%, and that looks okay with inflation at 2%, and inflation turns out to be 7%. So there's always risks in buying UK government bonds. A credit downgrade is a risk, because if it were to happen, it's almost certain that the price of bonds would fall, interest rates would go up. So we don't need to make our own independent judgments, because there are all kinds of smart people whose job it is in the financial markets to kind of work out, well, what are the risks of holding UK government bonds? How much did you pay for them? That's then reflected in the market prices. So, long-winded answer, we don't, in a sense, need to make those judgments. We assume that the market has reached a sort of balanced view on what the risks of holding UK government bonds is. I mean, right now, if you just look at what the government has to pay to sell debt right now, it's up relative to where it was a year or so ago. That's not unusual in the context of richer economies in general, because those yields have gone up in most places. They've certainly gone up in the US. In fact, the US and the UK cost of debt has pretty much gone up in line with each other. So there are sort of what you might call heightened concerns about debt. It's not surprising in a sense that that's happened, because the stock of debt issued by governments right across the richer economies in the world has gone up very markedly in recent decades. And so, although our report, is in some sense full of a lot of risks and uncertainties, and reflects the fact that the government's running a deficit and the debt is high, you could write a report which looked kind of similar for a lot of the richer countries in the world at the minute.
Thank you. Tom, we got a question on our work on climate damage, which I'll come to you on. How solid are your estimates of the GDP hit from climate damage? Given tipping points, is this essentially unknowable?
Okay, thanks. Well, it is certainly the case that the estimates of the economic and therefore fiscal damage from climate change are very uncertain. I mean, we talk about uncertainty a lot in this report, but I think this is an area of real particular uncertainty, given the sort of uncertainty both in terms of the extent of climate change globally, the impact that will have on global weather patterns, the impact that will have on UK weather patterns, and then the impact that has on the UK economy. So quite a long chain there. The estimates we use are based on studies produced both in the UK and internationally, looking at the impact of climate change on GDP over the past and trying to extrapolate that into the future. Those estimates have actually increased pretty sharply just over the past year since we last did an analysis on this topic. So those studies generally have found that damage is likely to be greater than previously thought and more persistent. But given the uncertainty, that's why we produce a number of scenarios in the report where we look at different assumptions, and those different assumptions can have a pretty material effect on the UK public finances. We do also say in the report that we think the risks in this case are probably skewed to the downside, and that is partly because of the factors mentioned in the question around the risk from what are known as tipping points, so basically major global climatic events that could have a much more significant impact on weather patterns and therefore on the economy, but are essentially extremely difficult to kind of model or quantify in any robust way. And it's also the case that the models that look at the UK generally don't consider the risk of kind of economic spillovers from climate damage in the rest of the world and the effect that could have on the UK economy, which is, why we say we think the risks are probably skewed towards the downside. I mean, there is also upside risk. The economies could be more resilient to climate change than the models might expect, and it's certainly been the case in the past that economies have kind of proved more resilient than people thought to shocks, so COVID is one example where the economy actually, in many ways, was able to sort of adjust more quickly than a lot of people thought at the start. And of course, new technologies may come along that will make it kind of easier to deal with climate change. So there is also some upside.
Thank you very much. Richard, I think we have to come to you for this next couple of questions because one of them starts, hi Richard. Sue Chan says, hi Richard. You said that the UK cannot afford the array of promises that it has made to the public. How soon will hard choices have to be made? Chris Smith from The Times asks, given your stark warning that the current path of debt is unsustainable, how long do we have to make painful choices before we risk a debt spiral? And Ian, also from The Telegraph, asks a very similar question to Sue.
Yeah, so I think to some extent hard choices have already been made and are being made. I mean, most notably on the tax side, where successive governments have raised the tax burden in this country from around 33% of GDP, and within 2 years it will have gone up to 38% of GDP. And a 5 percentage point increase in the tax burden is historically unprecedented. It will bring the tax burden in the UK to its highest level since the Second World War. Unfortunately, that still leaves for the moment, that still leaves the UK with a deficit of 5% of GDP. That rise in the tax burden is just enough, based on the policies we assessed back in March, to get the deficit down to a level where the current budget is in balance, where government revenues are just enough to cover day-to-day spending in the UK. It still leaves the UK with a debt burden of around 100% of GDP and a very high cost of debt. And so, to some extent, the government is taking the difficult choices it needs to on the tax side to consolidate the public finances. When you look ahead, based on our last set of 50-year projections, the level of debt rises, and then it sort of levels off for a few years over a decade or so before it really starts to hit the sort of snowball phase as you get out to the middle of the century. But the reason it's leveling off is for quite a depressing reason in terms of long-term demographic dynamics, which is that there are fewer children, which means that the cost of educating them is less. But what that also means is you've got fewer working people in the future supporting a much older population. So there is a bit of a window of opportunity to get ahead of those demographic dynamics by getting the public finances into a safer position. Unfortunately, at the moment, when you look at the UK's current financial situation compared to its peer countries, we've got the 6th highest level of debt, the 5th highest deficit, and the 3rd highest borrowing cost of 36 advanced economies. And that just leaves us in a particularly vulnerable position when you look at other countries who have been sort of quicker at actually consolidating their public finances, getting them back to a more resilient position in the wake of the same kind of shocks that we've faced over the last 5 years.
Great. We've got just a couple of minutes left, and a nice question to end on. I might come to Tom first, because I think he's got the right bit of the report open, but we'll also use it as an opportunity for any of the panel to offer any kind of final thoughts. The question is from John Paul Ford Rojas. Overall, are the risks you outline greater or lesser than they were this time last year? So that's kind of a nice question to end on. What's the vibe of our assessment this year? From Tom first, and then any of the panel.
So in the risk register section of the report, which is the bit, as you say, I've got open, where we kind of do a wider assessment of a wider set of risks to the public finances, and that's something we kind of update on a regular basis. And we essentially do say there that kind of risks are elevated compared to the last time that we looked at this. There are some risks which have crystallised that we've highlighted before. The trade tensions are one. The geopolitical risks are one as well. And I'd also add probably in the climate change analysis, which we've done this time, as I just mentioned, the sort of assessment of the damage costs is higher than in our last assessment, although the assessment of the cost of the government of the transition is actually lower. I should leave my colleagues to talk about the other areas.
David, what would you like to add?
Nothing very optimistic, unfortunately. I think the risks are a bit clearer than this time last year. Some of those risks may go away. I mean, one of the things that obviously wasn't really on the horizon, not clearly anyway, the last time we did this kind of long-term look was trade disruption, tariffs, the situation with the US potentially imposing very high tariffs on a range of countries, and the possible retaliation from that. And it's very unclear how that'll play out, but it self-evidently is a risk. There's no good news in that story for the UK, really. The pension issues that we spent some time talking about earlier, and there's a long bit of analysis in the report, we hadn't, in a sense, quantified how much the changing landscape there with defined benefit, defined contribution schemes holding different amounts of gilts and that changing over time. We hadn't quantified quite what that might mean for the cost of UK government debt. We made an attempt to do that here. It looks like, other things equal, something of an increase in the cost of government debt gradually over the long term, but of course that's not helpful given the amount of debt out there. And the climate risks, as Tom said, look a little bit worse, and the kind of damage you might expect, the physical damage to the UK, probably a little bit more severe now than it looked a year ago in the eyes of the scientists who are the experts in this area, and we take their views seriously.
We're at time, Richard. Any final thoughts to add?
I mean, just to say, there's a very rigorous answer to the question in chart 5.1 at the back of our report, which is the product of lots of hard work of the staff and the OBR and assessing each one of those risks on our fiscal risk register. And it does show, unfortunately, that the weight of risks are on the side of things that have increased rather than decreased. And I think more worryingly, as we've underscored in this report, the public finances resilience to those risks in comparative terms when you compare us to other advanced economies, it is also less, and we look less resilient to those risks than some other advanced economies that have got their public finances in a more sustainable position in the wake of these shocks. And so those are the issues which we've tried to draw attention to today, and we will continue to do so. Thank you.
Well, David, you're right. That was a very gloomy note on which to end, but we do have to draw things to a close there. If any questions that we didn't get to, do feel free to get in touch with us, and we'll always do our best to respond to questions or requests for further information. So I'll wrap up by saying thanks to all of you for joining today. Thanks again to Liverpool City Council for hosting us here, and we look forward to seeing you all at our next event following the publication of our economic and fiscal outlook in the autumn.